Hey, in this video, I'm going to talk about some riders of life insurance. Some of the riders I think is a good rider. So some of the riders I just feel it's not really needed. Anyway, so let's take a look at it. First is a disability waive of the premium rider. So this basically says if you're disabled, insurance company can waive your premium. So this is kind of a need. With most policies, this rider provides that if the policy owner is disabled under the definition of the contract, the insurance company will waive the premium for the base of the policy, generally all riders. Then the policy will continue as if the premium were being paid. So basically, you have to qualify as what is disabled, right? Under their definition. Then the policy is even you are not paying the premium, your policy is still in place. So basically say if you die, you still beneficiary still get the death benefit. So it's like your premium is waived, but your policy is still in place. At no time will the policy owner will be required to repay any premium waived on account of qualified disability. So you may not require to repay the premium, which is great. So with most company, a qualified disability must last 6 months before the premium is waived. Often once the qualification has been determined, the premium that were paid subsequently to the date of the disability will be refunded. So basically say you disabled today, then you qualify for the premium waive, but you have to wait. This is a waiting period is 6 months. So you wait 6 months, they will start waive your premium, but they will refund the premium you paid within 6 months. Another thing need to pay attention that any loan interest will still be required to be paid. If there were large loans, the policy may still lapse if the clients cannot cover the repayment. So just be careful. If you do have a loan, you have to continue to pay the interest, although your premium of the insurance is waived. Another is disability income rider, very similar to disability waiver. So basically, they combine two, say waive the premium and supplemental income if the insurance is disabled. Generally, monthly benefit equal to, you will get monthly benefit, a percentage of the face amount. Commonly, the percentage is 1%. Therefore, $100,000 policy would be paid $1,000 per month. Then here you will say, okay, I have $1 million policy. Do you get a $10,000 per month? No. The thing is, there will also be restriction as to maximum monthly benefit and the coordination of the benefits with other disability policy or the benefits to avoid creating moral hazard. So basically, you have if you have other disability policy, be careful. If you had a workplace, they pay insure you for the disability. If you choose this one, you may get let's say $2,000 per month. However, if the other policy pay you another $1,000 per month, so this one will reduce to $1,000. So that's just the details you have to look into the policy. Do not double insure for the same thing. Sometimes you pay the premium, you get the less benefit. Do not double insure. So that's this disability income riders. This is Presumptive Disability. What does this mean? So this provision may result in the waiver of the premium being effective without total disability of the. So basically, original definition may be very restricted. Say, if you are disabled, your disability has to be, total disabled, right? So this one they can specific say loss of use, loss of your eye or hands or something. If one of those events occurs, the disability will be presumed to be total, and premium will be waived under the same term as the waiver of the premium. It's very interesting. They say, well, under the contract, it's very restricted on the what is total disabled. So you buy another rider that will tell you, say, if you just lose the hand, we'll assume it's you total disabled. So we're gonna waive your premium and pay you income as well. So it's just pay more money to insurance company. Critical ill riders. The critical illness rider allows the clients to accelerate a portion of the death benefit of the life insurance policy. The policy will provide a specific illness such as terminal disease or chronic illness that require continuous care over the extended period. The disease will be listed, and many policies will also include items such as heart attack, stroke, and cancer. The amount of the accelerated benefits made available will be depending on the diagnosis and the life expectancy of the time of the diagnosis. Obviously, this reduces the death benefits that family will receive. The insured may choose to take the benefit of the or portion, leave the balance for the family. There may also be other requirements such as policy remaining in effect for a certain number of years. So this one is very similar to the accelerated death benefit rider. So percentage of the death benefit can be accessed. The wider availability of the accelerated death benefit rider has reduced the need of the wide article market. No income tax on the benefit. Okay, so basically, if you critical or ill, you have certain disease like cancer, stroke, this situation happened, you may not live that long. So insurance company allow you take the death benefit, which those death benefit is income tax free to you. So then you can use those money to pay, medical bills, can pay the caretakers, all those things. Of course, those benefits will reduce your death benefit when you die, so your family will receive less death benefit. So that's something. Long-term care rider. So this is similar to, this is kind of popular one. So this rider allows the policy owner to access the death benefit to pay for the long-term care related expense. The amount of the death benefit and the long-term care allowance based on the insured age, gender, health at the time of the purchase. The death benefit is reduced by the amount used for the long-term care expense plus the service charges. Some companies offer long-term care rider may also allow restoration of the benefit riders. As the insurer needed long-term care, draw down the death benefit value while receiving care upon death. This rider restores the death benefit to the original face amount. This allows the insurer to potentially use all the face amount for the long-term care, then family collect the full face amount of the death benefit. That's very interesting. Okay, so basically, well, if you need long-term care, so just to be careful, long-term care insurance exists. Then also what being have the definition of the long-term care need is 2 of the 5, some like daily living, you cannot function in that way. So anyway, there's a specific definition in order to be qualified as a long-term care. So if you want to use this rider, then make sure if you have other long-term care policy, just be careful how those policy working together. So I just don't know this restoration benefit rider. Well, the more rider you have, the more premium you're gonna pay. So you have to balance those things. So last slide, I'm going to talk about a family income benefit rider. So this is very interesting. So this rider provides the benefit payout will automatically be spread out the monthly benefit, removing the choice of the payout option from the beneficiary. So basically, you cannot take a lump sum monthly, take a monthly benefit. It is especially beneficial for minor spouses who have difficulty managing money, special needed children's. So if the beneficiary cannot manage the money, so you may be well to use monthly benefit rather than lump sum. Return of the premium rider. This is interesting. Say some clients will purchase the term insurance, prefer to pay the premium, so if they do not die within the time frame, they will receive their premium back. So requirements are that the policy must be kept entire time and can cost 20 to 40% of the policy without such a rider. So designed to cover specific terms such as buyout, buy-sell agreement, or the specific loan. Maybe in some situation you need it. So you do know they cost you 20 to 40% more for the policy in order for you to get the premium back.